Welcome, and thank you so much for joining us. We are so happy to have so many nonprofit leaders and advisors on today's call. I'm Allison Helland. I'm the Director of Donor and Advisor Engagement at MCF. Before we get started, I just wanted to thank you for all that you do in your practice and in your careers to really further the conversation around philanthropy with your colleagues, your communities, your clients, and the donors that you talk to. We are happy to be a partner in that conversation, and we really appreciate and are inspired by the value it brings to our community as a whole. So thank you for the work you do. Before we jump into today's program, I did want to do a few housekeeping announcements. So for those of you who are Wisconsin attorneys, this program has been approved for 1 CLE credit for the live viewing. So if you're watching this on a recording, it does not qualify, but if you're here live today, it does. So make sure you record that. Secondly, I wanted to remind you we will be having our annual advisor seminar on August 13th at Monona Terrace from 2:30 to 5 p.m. We are very excited. Professor Samuel Donaldson will be joining us. The theme will be planning strategies for a shifting tax landscape. Depending on how things go with Congress this summer, the landscape may still be shifting, or we may have a little bit more of an idea of what's going on, but it should be a very timely topic. If you would like to register, my colleague Lex is actually going to put the link for the registration page into the chat here, so you can register right now if you'd like to. It's complimentary, but space is limited. So if you're sure you want to come and you want to make sure to save yourself a spot, please do so now. The other thing I wanted to remind you of is there are advisor-related resources on MCF's blog, or on MCF's website, I should say, including the advisor blog, Insight Ideas and Insights. Between webinars, we will be posting information and articles on a variety of topics, from basic things like the type of fund options we offer at MCF to more complex things like making gifts of non-cash assets. So if you're looking for information on a specific issue, definitely visit the blog. You may find something useful there. Lastly, if you have any ideas for future webinar content, or there's something you wish you'd see more of or a better explanation of in our materials or websites or programming, please reach out to me. I love having conversations with advisors and nonprofit leaders around how we can make the resources available to them better. So there's my contact information. I think a lot of you probably already have it, but if you don't, there it is just in case. And then lastly, if you have any questions for the presenters today, please drop them into the Q&A and they will address them as they come up. Now, to our featured speakers. I am really excited to be joined today by Steve Snyder and George Suttles. Steve is with Commonfund OCIO, and that is the outsourced chief investment officer for several community foundations, including MCF. George Suttles is with Commonfund Institute, which is an affiliated entity to Commonfund, and does a variety of research and thought leadership on market performance and trends in the philanthropic sector. So before we jump in further, I did want to give you a little bit more background about both of them. Steve is primarily responsible for the design, tailoring, and implementation of Commonfund OCIO's custom investment solutions through asset allocation recommendations, portfolio oversight and analysis, and rebalancing of portfolios. He served on the investment committees of the University of the Sciences in Philadelphia, and recently completed several terms as an investment community member for Lancaster County Community Foundation. George leads Commonfund's educational, thought partnership, and professional development activities as executive director of Commonfund Institute. He serves on multiple advisory boards and steering committees, including Intentional Endowments Network Steering Committee, which provides strategic guidance to the network and chairs the steering committee for the Impact Finance Center's Diverse Manager Initiative. He is a member of numerous nonprofit boards and investment committees, including Mertz Gilmore Foundation, Auburn Seminary, and the New York Foundation, where he serves as treasurer and chair of the investment committee. So with that, I'm going to turn it over to Steve and George.
Great. Thank you so much, Allison. And thank you to our friends at Madison Community Foundation for hosting this wonderful program. We're delighted to be part of it. And most importantly, thank you to you all for taking time out of your day to join us for what we hope to be a thought-provoking session where we provide some insights on things that we're tracking that could impact not only the nonprofit sector and investments, but also the philanthropic community. So we're hoping to make sense of that today, give you some trends that we're following, with one caveat that neither George nor I are tax experts. So it's nice to hear from Allison that you have a tax expert joining you for your next program. I know there might be some tax experts in the field today, actually on this call, nor are we legal experts. So what we're going to share is our view as sort of nonprofit fiduciary experts and folks that work as investment professionals as we think about the impact of policies on not only the markets, but the nonprofit community that we serve. And then as an extension of that, what that might impact in terms of the ask for philanthropists who you all serve. So again, that's the goal today. So I'm going to bring up my presentation slides here. So bear with me one second as I maneuver around that. Allison, if you can give me a thumbs up if you can see that. All right, perfect. So a couple different things on the agenda today. One, we thought we'd set the table on the implications for the markets, particularly around policies and things that we're watching as an investment management firm. I know some of you are financial advisors, so you'll probably be well aware of all these things, but obviously there's an impact immediately to the markets, and we've been seeing and hearing and reading about it every day about the volatility that has occurred since the turn of the calendar year and the focus on tariffs, which we hear about every day, it sounds like. The second piece then is to talk about beyond the initial focus on tariffs, what are some of the other policies that have been talked about that could have potential significant implications for nonprofits, impact on nonprofits, and an impact on the donor community, again, that you may serve in your day-to-day roles. So George will go through some of those challenges that we're tracking and then some of the potential implications for those policy impacts. And then we'll sort of morph it into the investment trends, what that means for individual investors. And then as we sort of broaden that scope out to nonprofit investors, which we thought would be particularly relevant because many of you work with ultra high net worth individuals who may be in a position to start a family foundation. And so we want to compare and contrast some of the differences between an institutional nonprofit endowed portfolio versus sort of an individual portfolio. So those are the goals for today. So with that, let's jump right in. Every quarter when we meet with our institutional investors, Commonfund is an OCIO firm, as Allison had mentioned. We have the great privilege of working with a number of nonprofits and managing endowed assets. And we often meet on a quarterly basis with the investment committee or board of trustees of these nonprofit institutions to share updates on the portfolio, talk about performance drivers, and talk about positioning in light of the current macroeconomic environment. And every quarter that we meet with these institutions and committees, we bring the three themes that we're watching. This happens to be the three themes that we were utilizing coming into this current quarter. So I'm going to focus on the middle column here, because that certainly has some impacts on economic implications on the left-hand side, as well as the market volatility that you're seeing on the right-hand side as the theme. But that policy uncertainty, the markets typically need clarity in where something is going. And what you're seeing is a lot of day-to-day volatility, sometimes downward pressure on the markets, sometimes quick recoveries from the markets, trading off of different interpretations of what's actually going to happen based on the rhetoric from the current administration. Ultimately, though, that's going to be defined. And as we sort of settle on what will stick as long-term policies, then it becomes a little bit easier to sort of project, how we think about opportunities that might arise from that, or where risks may emerge that we need to be cognizant of on behalf of our investors. And again, for those that are financial advisors on this call, you may be thinking about all these things as well for your individual investors. So I want to focus a little bit on the policy side of this. So with that, if we focus on the current administration, there were four main policy issues identified during the campaign of what they had suggested they were going to focus on. And these are the four. So taxes, tariffs, regulation, and immigration. And if we just map it out from a high level, if you think about it from an investment perspective, and just isolate these individually, and just think about the potential impact on the capital markets, we start with taxes. What had been suggested is tax reform in the potential form of tax cuts for corporations and possibly for individuals as well. So what that would tend to portend is potential growth in the US markets. So more dollars going to the bottom line means greater corporate profitability from corporate tax cuts. Individual tax cuts means more discretionary spending becoming available, typically as a boost for consumer spending. Those tend to be good things for the growth of the economy and positives for the capital market. So green, so directionally going up, a positive impact in growing the US economy, and a positive impact on appreciating the capital markets theoretically. When you isolate tariffs, right, tariffs are introducing an additional cost, either being borne by the corporation or being passed along to the consumer, which has a detrimental impact. It sort of serves to slow down growth and GDP growth. It serves to increase inflation. So directionally, you'll see that arrow for inflation going up, but rising inflation tends to be a bad thing. That's why it's sort of colored in this orange or burnt auburn or red, depending on your perspective. And those two things, a slowing economy with rising inflation, tend to be difficult signals for the capital market. So typically you would see downward pressure there. From a regulation standpoint, if we see any level of deregulation, again, that tends to provide a stimulus for US growth. There's some cost-cutting measures that could be realized with less regulations and less regulation compliance on the corporate side. It would tend to lower inflation and inflationary pressures, which again would be a benefit to the capital market, so a positive there. And then immigration, that fourth policy line at the bottom there, if you have any policies limiting or restricting immigration or taking a hard stance on immigration, that could exacerbate a labor shortage, put pressure on wage inflation, and potentially have the impact of serving to slow down the U.S. economic growth as well. So that would generally be a negative for those two things. Remains to be seen about the potential impact on the capital markets. So that's how we sort of frame it from a broad policy standpoint. What's been interesting so far out of the gate is that the current administration has focused on tariffs as the first thing. So this is Trump's second term in office. If we compare it to his first term in office, he had very similar views around a lot of policies that we had discussed on the previous page. His first term started in 2017, but out of the gate, the focus was on tax reform. And so I've mentioned before that taxes tend to be a positive to the market, particularly when you're cutting taxes. And so if you see the bottom chart on the left-hand side here, this is measuring the S&P 500 response. So 2017, the first year of Trump, we'll call it 1.0, first administration, versus Trump 2.0, the current administration. So Trump 1.0 out of the gate focused on tax reform. The markets responded positively, and you see this upward trend line of the S&P 500. Then in the second year, the focus shifted from tax reform to tariffs, which we know tend to have a negative impact on capital markets. And you can see that in the gold line here. This was 2018. It was the introduction of the first trade war with China. And you can see the market volatility increased, particularly a lot of downward pressure on the S&P 500 and a lot of significant volatility in trading periods in 2018. What we saw from Trump 2.0, first year in office, was the focus immediately out of the gate was on tariffs. And it was a remarkably similar response in terms of volatility, and particularly downward volatility out of the gate when the focus was on tariffs in this term. So we saw a pretty significant sell-off through the end of March and the beginning of April. And then by April 9th, we started to see a crossover where Trump had sort of pulled back and put a delay, 90-day delay on some of the tariffs imposed on some of the trade partners. And the market sort of read that as a positive sign that, we may not get the full extent of the tariffs that had been originally proposed. We saw the market sort of rally on that news. Still lots of uncertainty, but remarkably, the S&P 500 sold off about 20% in the early part of this year and has now recovered slightly more than 20% in that downturn. So lots more to come on that. The reason that's meaningful for us, and we have the luxury of working with nonprofit endowed institutions that are perpetual pools of assets. And when you have a long-term investment time horizon, and this is where it may differ just a little bit from some high net worth individuals, when you have a long-term perpetual time horizon, you have the ability to withstand short-term volatility. Typically because you don't need 100% access to your capital at any given point in time. You're taking a spending distribution as a percentage of those managed assets to support the community through grants. So this is plotting the S&P 500 returns on calendar years going back to 1980. The blue bar graphs here are the annualized returns of the S&P for each year from 1980 through 2024. The gold dots represent the intra-year sell-off that occurred. So every year there's been a sell-off in the S&P 500. Sometimes they're short sell-offs, sometimes they're prolonged sell-offs, but every year has experienced some sort of drawdown within the markets. And in some years where there's some significant drawdowns, the S&P is still finished in positive territory. So if I think about 2010 as an example, peak to trough intra-year, the S&P sold off 16%, but finished the full calendar year up a positive 15%. So if we put it in the context of what we talked about earlier from policy standpoint, let's go back to 2018 when the focus of Trump 1.0 was on tariffs. You can see that intra-year sell-off of 20%. Before the focus shifted beyond tariffs to other positive impacts on policies, and the S&P 500 finished the year negative 4%. So recovered a bit from the peak to trough sell-off. Ironically enough, it's been a similar story like I talked about earlier. We saw a 20% intra-year sell-off of the S&P 500. Now, calendar year to date, it's slightly positive. So we recovered from that 20% sell-off with a pretty significant rally. So a lot of way to go, a lot of runway here, still not finalized on policies. But one of the things that could be encouraging is that focus on tariffs out of the gate is now starting to turn to the tax reform. And in August, we're going to start to see a little bit more focus on taxes, which again could be a boost or a positive in terms of sentiment for the markets, and we'll see how the market reacts to that. But again, we have the luxury in managing long-term assets where we can ride through some of this volatility. We're aware of it. It may be more painfully acute, though, for you all who are working with high net worth individuals that may have finite timeframes or the need to spend some funds and need to be wary about market volatility. So that just sort of sets some context from the investment side. Let's turn it over to George then to sort of talk about some of the policy considerations for nonprofits and how that might impact philanthropists. But before I do so, just a friendly reminder of what Allison said. Please feel free to put forth any questions of anything you hear into the chat. George and I will monitor the chat and address those questions throughout. So George, I know you've been monitoring. Any early questions come through yet?
No questions as of yet, Steve.
Okay, all right, sounds good. So over to you.
Thanks, Steve. So, Steve, you get the luxury of telling this community here that although there was some initial turbulence, markets seem to be trending positively. And then I get to talk about all of the myriad of challenges that the nonprofit sector and the philanthropic sector is facing more broadly. So quite the seamless handoff from good news to now. I get to talk about some more sobering stuff over the next few slides. So as both Allison and Steve mentioned, the Commonfund Institute, one of the cornerstones of our work is benchmarking, and we've been privileged to work with the Council on Foundations, on the Council on Foundations Common Fund study of foundations, where we're able to measure and collect data on best practices in investment governance. And a few years ago, we started asking our private and community foundation benchmarking participants what their top concerns were, because we really wanted to be able to keep our finger on the pulse of what was keeping private and community foundation leaders up at night. To be fair, this whenever we're doing benchmarking work, we're looking back retrospectively. So these charts here really do look at the top concerns that were sort of keeping private and community foundation leaders up last year. So we collected information for fiscal year 2023 and 24, and then we actually have the fiscal year 24 CCSF survey out in the field currently. But as you can see, and what Steve sort of lifted up is a lot of the concerns that we saw private and community foundation leaders grappling with last year are going to be present this year. Looking at long-term volatility in the financial markets, so this administration, their policies are causing some of that volatility, or some of that volatility can be contributed to the turbulent public policy landscape, but an overwhelming percentage of our private, family, and community foundation leaders are really looking at that longer-term volatility and how it's going to impact not only the markets, but their portfolios. And then with that, and related to that, is not meeting target returns. And so if we're thinking about CPI +5 as a hurdle, and then really thinking about intergenerational equity, how do we maintain the purchasing power of our endowments so that the grants can, we can sort of maintain our ability to make grants to communities that we care about. That's another top concern for private and community foundation leaders. And then inflationary pressure continues to linger, although some of that has tempered a bit, but we still have inflation over 2.5%, and so that's something that we continue to track. So I think it's just really important to understand that although these concerns are from last year, a lot of them still prevail, and whether you're working with high net worth and ultra high net worth individuals on the private side and helping them think about their philanthropy, or you're working with institutional philanthropic leaders, this is sort of the basket of concerns that I think we're going to continue to see. Although I bet that the turbulent sort of public policy landscape is going to be sort of the top concern, and then filter down and sort of related to these as well. Next slide, please, Steve. All right, here's the part that's sobering. Seismic shifts impacting nonprofits. So if we get the pleasure of working in the philanthropic sector and deploying resources to nonprofits, it's important for us to understand how our nonprofit partners are impacted. And so reductions, freezes, or elimination of federal funding, in practical terms, we are seeing this across the country. Nonprofits, big and small, being impacted by federal freezes, federal cuts. And so what are the implications of those cuts for the nonprofit sector? And then related to those cuts, how is philanthropy, both private and institutional, going to be motivated to or asked to respond? Steve alluded to this, potential changes in the tax law. We have seen that the latest House Ways and Means Committee's legislative draft does focus on updated tax implications for private foundations. And so whether you're on the private side or the institutional side, really understanding what those new tax implications are going to be by asset size are going to be really, really important. And we're doing some illustrative modeling to try and see how that's going to impact institutional philanthropy and our ability to sort of deploy resources to communities. The top headline is it's going to have an impact, right? The more we pay in taxes, the less dollars that are available for grants. And so what are the implications for that? Threat of legal action. I think we've seen this since inauguration, to be honest. Like it has been on our radar that the nonprofit sector more broadly would face existential threats from this administration. So I think we're seeing that in terms of a threat of legal action. A perfect example or glaring example is what's the legal battle that Harvard University is in with this administration. So I think we're going to continue to see that in the nonprofit sector, in the judiciary, as public policy comes down from this administration, and then the nonprofit sector and different verticals from the sector take these issues to court. It's worth mentioning changes to the Department of Education. We were trying to be tactful and subtle when we put this bullet here, changes to the Department of Education. The rhetoric around this is really a lot more sobering. It's a dismantling of the Department of Education. And for those of us in the social impact space that understand that complex social and economic issues are multidimensional and intertwined, it's scary to think as folks in the nonprofit sector and folks in philanthropy, what a dismantling of the Department of Education could mean and what kind of ripple effect that would have in communities that we care about. So that's something that we just continue to track from an impact standpoint, from a tax standpoint, and then given that a lot of our clients are in higher ed, just trying to be good partners there as well. Potential Title VI enforcement. This is really focused on a lot of the anti-DEI sentiment that's coming out of this administration. And so a lot of philanthropists who were committed to doing work focused on DEI, racial equity, or any of the adjacent types and scopes of work that are connected to diversity, equity, and inclusion are going to be scrutinized and potentially threatened. And so that's something that we're monitoring, because for us, especially, we have clients who care about DEI, who care about social equity and social justice work. And so what are the implications there? Dear colleague letter, this is really important. We connect the Dear Colleague letter concept to anticipated obedience or anticipated compliance. And I'm sure a lot of you have heard that term. So the Dear Colleague letter is just a letter that comes down from a federal agency that says, hey, we've been given a mandate. This is how we're interpreting that mandate. And here's what might come out of that interpretation of the mandate. To be clear, a Dear Colleague letter is not a law. And it does not make an activity legal or illegal. And so that's why I think we think about it in terms of anticipated compliance or obedience, because we've had clients ask us, this Dear Colleague letter's out in the world. Does this mean that it's illegal or legal? How should we respond? How should we react? And so, I think the prevailing guidance just broadly, not just for our clients, but just more broadly is, one, contact your general counsel or your lawyer. And then two, begin to shift your risk management framework to understand, well, if it's not illegal and it's an important part of the work that we do as philanthropists and nonprofits in the sector more broadly, how do we continue to do this work? And then how do we manage the risk, given that we've received a Dear Colleague letter, but it's not illegal. And so there's been a lot of sophisticated crisis and risk management that we've supported clients around, just to make calculated and strategic and prudent decisions around how they continue to do their work, given that a Dear Colleague letter isn't law, but it could be a signal for future risk. And so important to mention that. Potential changes to the Charitable Act. Actually, Steve and Allison, this may be one of the few bright spots that I've got in my comments. And so the potential changes to the Charitable Act are meant, the Charitable Act is in the House right now, and it's actually meant to re-incentivize middle-class donors to participate in philanthropy in the nonprofit sector nationally. And so some of the provisions focus on a flat deduction so that it makes it easier for middle income donors to participate in philanthropy. And then it makes it easier to deduct. It lowers the threshold. And so you can actually capture deductions at a lower threshold. And so if you're not a billionaire philanthropist, but you're a middle-class donor, there's an opportunity that the Charitable Act presents for you to sort of re-engage in philanthropy and capture some tax benefits. So the Charitable Act, a lot of our partners, Council on Foundations, the Council for the Advancement and Support of Education, just to name a few who we're in deep partnership with, are doing some advocacy work around the Charitable Act and trying to get that sort of across the finish line. Unclear, but there are advocates doing that work to encourage philanthropy across socioeconomic classes. And so that's really encouraging, we think, to motivate and continue to encourage philanthropy across all the tiers of socioeconomic class. And then we'd be remiss if we didn't just mention immigration, right? This is a prevailing shift in public policy that's impacting nonprofits all across the country. I was recently, actually, Steve and I were both recently at an independent schools conference where independent schools were thinking about developing protocols and processes to protect their students from ICE. And so what are the implications of nonprofits really trying to navigate how their work and the communities that they care about are connected to these immigration policies is a seismic shift, because it's going to take nonprofits shifting resources, shifting FTEs, and really being diligent and vigilant about understanding how immigration impacts their work. Not just if they do immigration work in particular, but if they do basic needs, social service work, healthcare work, et cetera, et cetera. So again, we'd be remiss if we didn't mention immigration as a prevailing risk that a lot of our clients and a lot of our strategic partners more broadly are considering, even if they never had to consider it before. And so that's sort of the type of public policy environment that we are in. Sorry, y'all. I only had the Charitable Act as a bright spot, so I apologize. Response from foundations to the current environment. As Steve and I both mentioned, we've got a pretty robust partnership with the Council on Foundations, and this comes from a flash survey that the Council on Foundations opened up to members in March 2025. What we love about this flash survey is that it really does give us real-time information about what institutional philanthropic leaders are thinking about. And so what I might point you to is the bottom half of this vertical chart that looks at some of the ways that institutional philanthropy is thinking about showing up to meet the moment. So we're looking at exploring new resource leveraging approaches to support grantees, increasing flexibility in grant-making processes, shifting grant-making priorities to address new or worsening funding gaps, and seeking new opportunities to collaborate with other funders. I think it's important to focus on these four because I think they'll have implications for both private philanthropy, so high net worth and ultra high net worth individuals who are engaged in strategic philanthropy, as well as institutional funders as well. So if I think about collaboration with other funders, there is a rich history of private donors and institutional philanthropy collaborating for collective impact. And so I think there are going to be opportunities for that given the moment that we're in now. Shifting grant-making priorities to address new or worsening funding gaps. We talked about the federal budget cuts and the freezes. Philanthropy is being called on to do more. And so whatever that means to individual philanthropists that you're working with, individual donors you're working with, or institutional philanthropic leaders you're working with, we all are being asked to do more. And so what are the implications of that, both from an investment standpoint, but then also from an impact standpoint? And then increasing flexibility in grant-making processes. So not necessarily giving more, but making it easier to give at the existing level that you're at. And so just wanted to share this with you all. We thought this really was a nice finger on the pulse of how philanthropic leaders are thinking about responding to meet the moment. And so just wanted to lift some of that up because we think it's pertinent for both individuals and institutional leaders. Thanks, Steve. funding and donor sentiment during this political climate. I don't know if you all are feeling this, but many donors are wary of public giving. There's a huge increase in institutional mistrust or distrust. And so there are a lot of donors and funders. And again, this is a broad blanket statement, but we're seeing the research showing that, there are a lot of donors who are saying, well, are institutions doing what they're supposed to be doing? Are they, exercising and activating people power in a way that feels right and good? And so there's some of that there as well. Actually, again, as I mentioned, our partners at CASE, again, the Council for the Advancement and Support of Education, have been following public sentiment around higher ed. They've been sort of measuring that sentiment for the last decade, and that sentiment continues to go down. So that's just another example of institutional trust sort of being a little bit shaky. And so what are the implications of that for philanthropy? But then also institutional philanthropy is facing existential threats from this administration. So I mentioned it here, but there's sort of this perfect storm of institutions are under attack. The public is hesitant to donate to institutions, whether either because of trust issues or they're concerned about retaliation. There was a recent New York Times article that shared that many donors, especially progressive donors, are scared to double down on their philanthropic investments because of fear of retaliation. So that's a real fear that's out there. And so donors who were traditionally connected to causes and institutions and were giving at a high level may continue to retract and wait and see because of those types of threats. But the interesting thing is, while donors sort of grapple with their own sentiments and their own feelings about what's happening sort of out in the world, there's this counter-cyclical effect. And in the nonprofit sector that we see is that whenever there's a donor contraction or federal, state, or local policy negatively impacts philanthropy or nonprofits or communities, the need for nonprofits increases. So a perfect example is the global financial crisis. Many institutional philanthropies who were invested in a certain way either drastically retracted their giving or closed their doors. And many communities, individuals, and families were hurting. But guess what? At the same time, because communities were hurting, guess what? Nonprofits were asked to do more. And we're seeing a lot of that counter-cyclical effect right now, where donors might be waiting to see, institutional philanthropy might be waiting to see, but the turbulence is causing real impact in communities. And so nonprofits are being asked to do more. And then by proxy, we think philanthropy will be asked to do more because nonprofits are doing more. So I mentioned perfect economic storm for donors and nonprofits, a perfect storm of donor hesitation, turbulent markets, and a fraught public policy environment that intensely dislikes nonprofits. I keep saying existential threats, and Steve knows this about me. I can be hyperbolic and dramatic sometimes, but I think we're actually really seeing that. We're seeing that the nonprofit sector is facing some existential threats that we just have to continue to keep an eye on. And then I just also wanted to point to some philanthropic shifts that we had actually been tracking for a while. So these aren't new per se, but we think they're going to have outsized impact just given the times that we're in. So what we were seeing that was trending, and this is true in the Giving USA data as well, is that nonprofits had reliance on larger gifts from a smaller pool of donors. And so that then increases the vulnerability of nonprofits to political and economic changes, right? And so nonprofit management and fundraising 101, what do we always say? Diversify your funding streams, right? But if philanthropy is consolidating, especially on the private side, then what are the implications of that last bullet for how we fundraise, how we connect with donors, and how we keep inflows coming in so that nonprofits can continue to do their work. These are just some of the shifts and sentiments that we wanted to share with you, many more. And I'm sure that many of you could add to this list, but these were sort of the four that we really wanted to uplift given the time that we have. Sorry, Steve, next slide, please. Actually, I stand corrected. I do have a little bit more of good news. The great wealth transfer. This is the estimated wealth that's slated to be inherited through 2045. And so this $80+ billion wealth transfer is going to transform philanthropy, transform financial markets, and transform the nonprofit sector more broadly. So this is just an amazing opportunity for us to begin to sort of cultivate responsible and strategic stewardship discipline, especially for next generation donors. Next slide, please. So the wealthy support different causes than the rest of us. And I don't know about you all, but I am not wealthy. So maybe I'll just speak for myself. This is the way wealthy folks are giving that I'm not giving. What's interesting here, this data is just from 2020 and 2021, but we found that it's pretty much tracking throughout. A lot of high net, ultra high net worth individuals will give to either their own family foundation, and that's listed as a gift, or they'll give to another foundation, or they'll give to a donor advised fund. Obviously, gifts to colleges and universities traditionally has been one of the top three. And then from there, we see social services, hospitals and medical centers, medical research, et cetera, et cetera. I did want to take this opportunity to answer a question that we received from Allison and the team before we jumped on this call. And it was focused on thinking about the impact of healthcare philanthropy in particular in this moment. And so what we really see is that traditionally, hospitals and medical centers, medical research, and human and social services were sort of in the top 10 of giving. But so take that and then think about the federal cuts to national research, national medical research. Think about the proposed federal cuts to Medicaid, SNAP, TANF. These are all programs that support low and middle income individuals and families, provide them access to healthcare, provide them access to other social services in terms of, thinking about social determinants of health. So I really do think that with this trend, coupled with what we might see come down the pike from a public policy standpoint, there's going to be a special opportunity for healthcare philanthropy, not only to fill some of those gaps in healthcare research and health insurance access to primary care and other social services that are connected to positive indicators for health. But I think there are going to be some strategic opportunities to innovate as well. So not just fill gaps, but I think there are going to be some more sort of community-centered opportunities thinking about healthcare access that could be exciting for healthcare philanthropy more broadly. So just wanted to make sure we covered that question that we got in advance of the presentation. Steve, is that your way of moving me along? I get excited about this stuff. So Steve's like, next slide, we're just going to move you along. Sorry, but we are pressed for time. So apologies. Next generation of philanthropists, shifting priorities. We already see the generational shifting priorities from the baby boomers to millennials to Gen Z, et cetera, et cetera. And so really keeping track of that is going to be important. We see that millennials and Gen Zers are really, really keen on understanding sustainable investment and impact investing strategies. And so if you're thinking about engaging with those donors, you should have some sense of where those opportunities are, technology and transparency, really thinking about digital giving platforms and engagement platforms, and leveraging AI is going to be really important. Women as philanthropic leaders, the women will save us all. I do believe that as a philanthropy wonk. And so where are the opportunities to continue to uplift women donors as philanthropic leaders and engage them in a way that's meaningful and multidimensional? And then the continued rise of donor advised funds. I think we're going to continue to see donor advised funds as a strategic mechanism for philanthropy, especially since private foundations are facing some shifting and changing tax regime. I think you're going to see donor advised funds as a nice lever to sort of avoid some of that and still be impactful and deploy resources. Next slide, Steve. Top 10 giving causes of the next generation. Again, this really is just a snapshot to show you how different generations are thinking about philanthropy. There are some similarities, but then there are some marked differences between how baby boomers think about their giving and then how Gen Z and millennials think about giving. Here, we only juxtaposed Gen Z with millennials. But what's interesting is that both generations are looking at supporting K through 12 and post-secondary education a little less than baby boomers. And so what are the implications of that and what are the reasons for that? And so we just continue to track that in the data as well. Next slide, please. And then education contribution trends by generation. I alluded to this. We think that millennials and Gen Z are less likely to support, K through 12 and post-secondary education, because if you think about those two generations, high levels of student debt, several economic downturns, turbulent job markets that have been faced, especially by Gen Z. And so when you're thinking about what Gen Z and millennials, what they've been through, and you connect it to what their appetite is for different giving verticals, it's going to be important to understand what they've experienced so that you can connect them to philanthropic opportunities that are going to resonate with them. Next slide, please. Steve, I'm going to bring you in because I know some of our clients are leveraging this, so I think it'll be important to mention.
Yeah, I think one of the things you heard from George earlier is the reliance on major gifts supporting nonprofits. And, we used to call it the old 80-20 rule where, 80% of your fundraising comes from about 20% of your donor base. It's actually been a little bit more acute. George had mentioned that independent school conference that we both went to recently, and they've updated their study data to show it's actually sitting around 93.7 right now. So 93% of their philanthropy has come from major gifts and major donors. So it's a small number of donors really moving the needle. And so this dilemma that they face with everyone trying to become much more efficient, really doing targeted fundraising, you can't ignore the small gifts. The small $1,000 and under gifts really do add up over time. But recognizing what moves the needle for them, they've really structured their development and advancement arms to really focus on cultivating the large gifts. And they've struggled with how do they allocate resources to properly tend to the development and cultivation of smaller gifts. And so one of the fascinating trends that we're watching very closely is this emergence of the use of artificial intelligence in development and fundraising. So a number of higher ed institutions are participating in a pilot program that launches virtual engagement officers. This is the VEO, or virtual engagement officer, for the College of William and Mary, second oldest public college in the country, just behind Harvard. They named her Ren. So this is the AI-generated VEO. Her name is Ren, and she is named after the academic building that sits behind her in this picture. It's the oldest continuously used academic building in the country. It's where Thomas Jefferson studied, so hence the name. And so what these institutions that are participating in the pilot program have done is they've carved out a number of smaller donors historically, or lapsed donors, to give to these virtual endowment officers to manage in their book of business. And the results have been fascinating so far. So in the first 5 months, nearly $500,000 was raised by these VEOs. There were 13,000 plus donors managed. They secured more than 2,300 gifts. You can see those stats in the bottom left-hand corner. But what was most surprising to those participating in the program is the data charts on the right-hand side. So the recapturing of lapsed donors has happened at a 3 times quicker pace than the traditional approach of managing it through human development officers. And the retention rate has gone up in terms of retaining donors. So it's really been fascinating, the early results from this. And so it's really that merging of the use of technology to create greater efficiency to manage a need for donor engagement, and particularly engagement with younger donors or lapsed donors, while they can continue to focus on the cultivation of larger gifts. So something that we'll continue to watch, but we thought it was a fascinating trend. So I'm going to keep an eye on time. I know we've got about 10 minutes left in the program. We've got one more section to go in terms of investment trends. And maybe just as a quick reminder, you have a link bar at the very top or bottom of your screen, depending where it's appearing, where you can mute yourself or control your video options. I believe the chat has been disabled for general participants. If you don't see a question and answers icon, you might just have to click on the more, and you'll see a questions and answer link there. And that should take you to that dialog box where you can submit questions. So please feel free to do that. So George, before we move on to the last section, which is investment trends, do you want to wrap up real quick on introducing the concept of the 6 Ps?
Yeah, thanks, Steve. I'll do this really quickly. As it's titled, the 6 Ps of investment stewardship, whether you're helping high net worth individuals and families think about stewarding philanthropic assets, or you're working with institutional leadership, it's important to have an investment stewardship framework or roadmap or an approach. And this is one that we've developed that we think is pretty good. 6 Ps focused on purpose, policy, process, portfolio, people, and perspective. And so we just wanted to offer that as a resource to those of you who are working with in the realm of philanthropic stewardship, especially with an investment focus.
Thanks, George. So before we move on, a question did pop up in the dialog box, George, that's pertinent to your discussion and what you just went through. So the question is, what, if any, changes do you see in the mindset of people? Given what you said earlier, are people more likely to send money directly to charities rather than giving to DAFs? Any thoughts on that?
No, I mean, I think you'll have some exceptional folks who want to give directly to charities just for the relational aspect of it. But I actually think that DAF platforms, whether it's the commercial ones or it's community foundations, are going to have a unique opportunity to flex their leadership muscles in this regard. Because I really do think that DAFs are going to present an opportunity for philanthropists to continue to realize their impact and continue to pull that lever for resource deployment without having to worry about some of the risk management and tax regime implications that private foundations are going to face. So I actually think there's donor advised fund platforms have a unique opportunity to continue to show up as philanthropic leaders in this time.
Great, thanks, George. Okay, we're at the home stretch here. I promised to be quick with this last section. Want to bring it back to investment trends and sort of marry, what George had talked about with the outlook for young philanthropists versus older philanthropists, their views on investments, and juxtapose that to what we see from institutional investors, particularly nonprofits, which we think could be relevant as your high net worth individuals establish potentially family foundations, endow portfolios, and thinking about the difference between a long-term portfolio and then typically what's included in an individual portfolio. So this is survey data that we found fascinating. This one looked at how young high net worth individuals are investing. So one, on the left-hand side, the question was, what is their view and the best way to grow wealth? And what's sort of striking here is that it's less reliant on traditional stocks and bonds as your answer, right? This is ranked in order. So most often cited was investment in real estate, then crypto, digital assets was cited by about 28% of those surveyed, then private equity at 26%, and then stocks at 14%. And on the right-hand side, you can see the question asked was the percentage of young high net worth investors that have the following asset strategies or classes in their portfolio. So nearly half own crypto or digital assets. About 47% own stocks and bonds, 45% own gold, and 17% other alternative asset classes. So those are for younger investors. The same types of questions were posed for older investors defined by those over the age of 44. Same question, what is the best way to grow wealth? And you'll note here, one of the biggest differences is, look at the references to crypto and digital assets. Only cited in 4% of the respondents from those older than 44. So investment real estate, lots of commonality there. And then more traditional equities, both international equities and emerging markets, a little bit more prevalent in the answers of older philanthropists. On the box on the right-hand side, we also found this fascinating. 28% of investors over the age of 44 believe that it's no longer possible to achieve average investment returns by only investing in stocks and bonds. Whereas 72 investors under the age of 44 hold the same beliefs, meaning that you got to go beyond stocks and bonds to drive long-term returns. Yet only 5% of older investors hold allocations to alternatives. We thought that was relevant because as we compare and contrast to data that we see, that's probably the biggest difference between long-term institutional nonprofit portfolios is the use of these private alternatives or alternative asset classes as a complement to traditional stocks and bonds or equities and fixed income. So some of that data, we sit in this position that George had referenced earlier of having the luxury of partnering with a number of trade associations to do industry benchmarking to look at investment management practices of higher ed institutions, independent schools, and this specifically focused on foundations through our partnership with the Council on Foundations. So we do an annual study. It's based on calendar year end, which is the fiscal year end for most foundations. The most recently published report was based on fiscal year 2023, which is calendar year 2023. We're in the field right now, wrapping up our study. We expect to publish that in the next several weeks, the 2024 findings. But we survey a number of foundations on their investment practices, their return experience, asset allocation, spending, governance, size of committees, you name it. We collect a lot of really rich information. And so this is just a quick summary of the most recently published study. We had 182 private, independent, and family foundations, as well as 109 different community foundations that completed the 2023 study, representing $126 billion of endowed assets. You can see the differentiation in the size of investment pools. On the bottom left, about 17% had over $500 million in assets under management, 36% under 100 million, and 47%, nearly half, ranging between 100 million and 500 million. The types of foundations on the right-hand side, a little bit more than a third responding institutions were community foundations, just under half were private independent foundations, and 18% private family foundations. So this is the return data. We break out 1, 3, 5, and 10 net of fee returns. We break it out by 4 categories here, all responding institutions, whether it's private foundations, family foundations, or community foundations. The 291, you can see average 1-year return in 2023 of 13.4%. And then by the different cohorts of foundations, all private foundations returned 12.9%, private family foundations at 12.2%, and community foundations at 14.6%. And you can see the difference on the 3, 5, and 10-year numbers as well. We recognize that these are long-term pools of assets, and its primary goal is not only to provide support through their grants and distributions for their philanthropic efforts, but also maintain the purchasing power of their endowed pool. And so if you default to a private foundation that needs to spend at 5% per IRS mandates, and you peg long-term inflation at, call it 2.5%, we'll use CPI as the inflation measure, you need to earn 7.5% annualized just to maintain the purchasing power with zero real growth. That's not an easy task. That's a pretty high return hurdle. And in fact, as evidenced by the most recent data that we tracked, over the past reported percentile rankings for all responding foundations, to get that as a long-term return, you would have had to be in the 84th percentile or a top quartile performer, nearly top decile relative to your peer foundations to maintain intergenerational equity. So not easy to do. Here's the asset allocation breakdown. You can see it again by the 4 foundation categories that we're breaking out, color coordinated here. Total equities. So as point of reference, I'll pick on the all foundations. 67% on average of responding foundations had their portfolio allocated to equities. Within equities, they use both public and private. The private carve out is this orange rectangular box. So of the 67%, on average, it's invested in equities by all responding foundations. On average, 11% of that was in private equity or venture capital, so private alternative classifications within equities. And then you can see allocations to cash, core bonds or fixed income, credit, diversifying strategies or hedge funds, and then real assets, which could be both public and private real estate or public and private natural resources. Importantly, we're also measuring the exposure to illiquid assets. These are long-term, think of private equity real estate, traditional private equity, venture capital, private natural resources, private credit, long-term investments with lockups. So on average, all responding foundations had about 16% of their portfolio in illiquid private alternatives, 18% of all private foundations, 16% of private family foundations, and on average, about 12% of all community foundations are invested in illiquid assets. So again, a big difference from what you saw with the allocation of older individual investors, those older than 44, with less than 5% of their portfolio allocated to alternatives. So much higher allocation to alternatives in general, and a much higher allocation in particular to private alternatives within portfolio. And so what we mean by alternatives, you see the breakout on this page here. Things like private capital, that's private equity and venture capital, private credit as a fixed income alternatives, that could be direct lending type of strategies, non-traditional, non-tradable, private real estate, investments in commercial real estate or value add property development, private energy and energy infrastructure, marketable alternatives, probably better known as hedge funds, and then marketable real assets in portfolios as well. And the reason that institutional investors tend to gravitate toward greater incorporation of these private alternatives is they tend to be less efficient than the traditional publicly traded markets and can drive long-term return premiums if done the right way. And so what we did was we divided those responding to this foundation survey into 2 categories. Those with less than 20% in private illiquid investments in their portfolio, represented in the navy blue, and those with greater than 20%. And you can see over longer periods of time, 3, 5, 10 year, the average return was higher for those with more allocated to private alternatives. So this is something that's being recognized by this younger generation of philanthropists, the openness to the incorporation and use of alternative investment strategies outside of traditional stocks and bonds. And so we might start to see that creep up in family foundation exposure over time, given the result of that. And then finally, we've got a slide in here on spending. I won't go into this because I know we're just a few minutes over advertised time, but let me just pause here. I'll quickly check the Q&A post. Doesn't look like there's any questions. So Allison, maybe I'll turn it to you for any final wrap-up remarks.
Sure. Well, thank you so much, Steve and George, for your presentation. Shared some really great information, and I think it was very helpful to our group here. So I want to give Commonfund a big virtual round of applause for their stewardship and putting this data together, and also just sharing some of these investment trends. If you do have further questions for Steve and George, guys, is it okay if they send them to me and I can forward them on? Okay.
Sure, absolutely.
So we'll do that. Also, if you would like a copy of the slides, please email me and I can provide those to you as well. So thank you all for attending today. Thank you again to Steve and George, and have a great afternoon.
Yeah,
Bye.
thanks everyone. Appreciate it. Have a great day.
Thank you.